much for coming to this talk. According to the United Nations, the global financial crisis threw 100 million people worldwide into poverty. If you take a typical mortality rate for people in poverty of about 10%, that means that the global financial crisis killed 10 million people across the world. Some of those people would have been in this country. There's also all the stress and anxiety that has caused. But it's not just about job insecurity and debt. The crisis did actually kill people, millions of them. So the problem is to do with the monetary and banking system itself, and it manifests as chronic problems, and I'll go into that. Ben Dyson was the guy who set up Positive Money, which are a pressure group to basically try and educate people about money and banking and the problems with our current system. So the contents of the talk, basically, where does money come from? How is money created and fed into the economy? Why is there so much personal debt? Do banks, and this is a common charge put forward by some politicians and bankers, do banks really put more into the economy than they take out? Okay, and the last point is about QE for the people. I'll talk about that in a bit. So we have huge problems, in spite of what some politicians are trying to tell you. We have all of these things going on. None of them are good. The financial crisis led to civil unrest, a lot of protest movements. These are fairly left-wing protest movements, like the slightly sinister anonymous group there, bottom right. So the questions I want you to think about, kind of to frame this talk, is why are banks' buildings the biggest in any major city? And what is the source of the bank's profits? Why can they pay their senior executives so much money? Do they really earn it? Where does that come from? So we need to define, first of all, what is money? It's all of these things. But first and foremost, it's a means of exchange so that we don't have to have a barter system. We do not want a barter system. Money is a really good idea. Okay, so it's the birth of civilization. It's kind of what helped civilization, is the concept of money, a medium of exchange. That's been perverted historically, as we shall soon find out. But at its simplest, there's nothing wrong with it. It's supposed to be a store, a measure of value and a store of value if inflation is low. Promise to pay, trust inscribed is quite a fancy definition. It's a wealth enabler. It cannot be refused to pay off a debt. So if something's legal tender, it's money in this country, someone can't refuse that as a debt. Physical or electronic, we'll get onto that, that's kind of the crux of the matter. It's good for the payment of taxes, so if the government say this is legal tender, you can pay your taxes with it. It's anything that has purchasing power, really. You can even think of cigarettes in prisons as money in a sense. Money is as money does, and it has to be counterfeit resistant, so we have to be able to control it somehow. So to have an economy based on cigarettes wouldn't really work, because you've got to be precise with it. This is perhaps the most important one of all, is a record of debt-based credit. What does that mean? We'll come on to that in a bit. So money is regarded as being neutral, as the supreme arbiter of truth, but it's not. The way in which money is borrowed into existence, that's a weird phrase, isn't it? Money is borrowed into existence. This is what actually manifests as chronic problems in our system. In a sense, in a kind of naive sense, there are two types of money, although that's not strictly true. But basically there's debt-free money and there's debt-based money. There's money that's created as a debt, that's called debt-based money, and there's money that has no debt attached to it. So, in other words, if money is debt-free, it means you don't necessarily want it back. So it's a gift, you know, if I give my daughter some money, she's not indebted to me really, you know what I mean, that's a gift. But if I want it back at interest in a certain time, that is what's called an interest-bearing debt. Now, the notes and coins in your pocket is created by the Bank of England or the state at 0% interest, and it doesn't require, if I've got a £10 note in my pocket, it doesn't require that somebody else has to have an antimatter tenner, right? That'll become clear in a minute. It's purely an asset and is free of debt. So let's talk about debt-based money. Debt-based money or debt-based credit and money are pretty much synonymous. I would actually call them the same. Is the result of a loan, and it's an asset and a liability, and it has associated with it a charge of interest. So a definition of debt: a lender loans an amount of money to a lendee which must be paid back in a given time. The debt usually has interest added onto it, so that the total amount paid back is more than the original loan. All right, so if I imagine that this here is the zero level, this is zero, okay, and money and debt are created equally, so there's equal amounts of money, equal amounts of debt, but there's also some interest to pay on that loan, so even when you pay it off, you've still got some negative money, if you like, some interest to pay off. Not all debt is bad. Some debt is good, like self-liquidating debt, like loaning for a new factory to make new widgets which are profitable. The loan is repaid and you get economic growth. Nothing wrong with that. But too much of the debt in society in the UK, probably about half of it, is this consumptive debt. So it's to do with mortgage assets, mortgage prices, credit cards, unnecessary business debts, personal loans, overdrafts. It's these kind of consumptive debts that's weighing the system down. Who are we indebted to? This is an interesting one. We have a national debt and we have personal debt. Two different things. The national debt is the highest it's been in this country during peacetime ever. But worse than that is personal debt, because personal debt, there's more of it, and there's a higher rate of interest. So it's personal debt we need to be tackling first, and then think about ways of reducing the national debt. By the way, did you know that we pay, on average, the average person, whatever that means, pays something like £80–90 a month on interest payments for the national debt through their taxes. So that's nowhere near as bad as personal debt. You're probably paying £300 a month if you're on an average salary.
Do you include mortgages in personal debt?
Yes, about 50% of personal debt is mortgages. 10% is credit cards, that type of thing, and 40% is business debt. But without it, we can't have any money, that's the problem. But we'll see that in a minute. The debt can only be serviced in four ways. We need increasing taxes, reducing government spending, selling off the family jewels, or forced and unsustainable growth and unnecessary activity. My criticisms tonight do not apply to all, well, I'm attacking the system, okay? So Nationwide are trying their best in some respects to be ethical, mutuals, but the way in which they deal with money or create money is the problem that I'm attacking. So if there's anybody who works in a financial sector, I do apologise, I'm not having a go at you personally. Most of you are decent, it's the system that's wrong. So there are three fatal flaws of banking. The first one: when you put money into a bank, did you know it is legally no longer your money? The banks simply have an IOU to you. So once you put money into a bank, it's their money. You have a certain claim on it, but it's technically it's not yours. This is why we sometimes get bank runs. Like Northern Rock in 2007, which was the start of the credit crunch in this country.
What's 12 grand?
Did you really?
It's alright. Just shares that were given to you.
Okay.
Easy come, easy go.
12 grand, that might be killing a lot of them. Anyway, so if everybody wanted their money back today, well, this talk was written in 2012, so it's about 5 years old, this talk, but the banks could repay £71 for every £1,000. Before the crisis, they could repay only £12.50 for every £1,000 in your account. This is because of the temporary, kind of ephemeral nature of the money supply, and we'll go on to that in a minute. Banks can invest your money however they like, because it's their money. So if you want to, you don't want them to invest in the new weapons systems of BAE systems, then you know, if you want them to gamble on the price of food, but I don't particularly want banks to gamble on the price of food. I don't want them to push up house prices either unnecessarily, because it means that my kids have to go to the bank of dad, which is rapidly running out of money itself. And also, did you know that this is true of certain pensions, that money in certain accounts can be used to drive down the stocks in your own pension. So you could be putting savings in, and then your own pension could be devalued with the same money. That's how stupid the current system is. Because they basically, some banks take a position on financial markets that guarantees that. This is number 3, this is the big one. This is the big fatal flaw. I didn't believe it at first, it's so outrageous. But the evidence is overwhelmingly in its favour, and this is it. Whenever a loan is made, banks can create money out of thin air. They need a loan contract. Once they've got a loan contract, the money is made out of thin air, and it's not cash and notes, it's numbers. If there was nothing there before, then there's a loan event, the money appears as a debt. We're going to talk a little bit about accountancy here, so a little bit boring. But basically, if you imagine this line here, this is the amount of money or assets that the bank has. Let's talk about one bank, but you could equally apply this to the whole banking system. It's a fair analogy. So this is its balance sheet. The laws are basically through a double entry bookkeeping, which is just a way of minimising errors. So let's say that this is the amount of money in the bank. So let's say that the bank wants to loan this customer £100,000. Now a loan is an asset to the bank because they will get it back at some future time, they hope, and they'll have some interest attached to it, which is probably double what the mortgage is worth. And the loan is a liability to the customer because they need to find the money of the loan value and the interest. So when a loan is made, let's say the bank says, all right, we're going to loan you £100,000, the balance sheet, expands. So the house is £100,000. I mean, you don't get many houses for £100,000 these days. It might be a posh garden shed or something. But basically, you get an expansion of the balance sheet. This double entry bookkeeping. So the assets and the liabilities both spring up in tandem by the same amount. Brand new money has been created, and also brand new debt. So that person with the mortgage, that £100,000 goes to the person who sold them the house. So in a different bank account. But the balance sheet has expanded in tandem, and all that's happened really is that some numbers have changed. That's it. Just numbers have changed on a bank's computer system. It's also worth noting that in order to do this, a bank has to have a banking licence, it has to have a certain amount, a small amount of money held at the Bank of England for interbank settlements at the end of the day. And they have to have somebody's signature on the loan, and they have to kind of believe that they're going to pay it back, and they have to be credit worthy, although what precipitated the credit crunch was banks not caring about that at all, and basically the subprime mortgage market in America was what set the whole house of cards collapsing in on itself. Yeah, when I gave this talk, at this point there was I think it was in 2011, 2012, there was a banking apologist in the audience who didn't believe any of this. He said, oh, I've worked in a bank and that's not the way it works. It's to do with the money multiplier effect, that's what it is. None of this is true. Well, I shan't go into the details of it, but mathematically and schematically it's completely wrong. But this is the way it happens, and it even says so in the Bank of England financial abstracts, which I'll show to you in a minute. He said something about, the Financial Services Authority would never allow this, they would never allow them to create money out of thin air. But the Financial Services Authority, all they're bothered about is that those two, the double entry tallies, all they're bothered about is that the balance sheet balances, the assets and the liabilities. They're not bothered about the change, the expansion of the balance sheet, or the contraction in the balance sheet, as long as they balance. So there's nothing for them to detect or pick up anyway. So that was this guy's problem. He said, oh no, the FSA would never allow that. But the Lord Adair Turner, who was chief of the FSA, actually agrees with me, as you'll see in a quote later on, about the way in which money is actually created. Yes?
Can I just say, a third party, you've got your bank and your customer, but a third party trusts the bank and understands that the bank, or accepts that the bank has got £100,000 of value and hands over a house to the customer. So there is a third party what is willing to accept that the £100,000 actually exists and will give goods to the value of £100,000. So if a third party did not accept that the bank didn't notionally have £100,000, it would never work. So the third party accepts that there is money which has been created.
Hello. Hiya.
And does that still fit into the model and the explanation?
I think so, yeah.
Yeah.
I don't understand why it wouldn't.
Well, you say that money is created from nothing,
Yeah.
which, I accept what you've said,
Yeah.
but it is real money, even though it's been created from nothing. And it's
real in the effect that
you're able to buy goods with it.
Yeah, it's real in the effect that it's legal, and if you don't have enough money numbers in your bank account, bad things can happen to you. So yeah, I agree with you. But in another sense, it's kind of it's not. It's kind of ephemeral and kind of not really there, and it's just numbers.
Yeah.
In my job, I use numbers now and again. I'm not too bad a mathematician, but the bank seems to be able to extract money just by producing these numbers.
And we all accept that it's abstraction.
The thing you're describing is the money fulfilling its purpose as a means of exchange.
Mm-hmm.
So the person handing over the house is saying, right, I'm accepting this £100,000 as a means of exchange.
Yes.
So I can then use it to do something else, probably buy another house or buy something else. So it's fulfilling one of its purposes.
Which is with trust inscribed. That's one of the definitions, wasn't it? Yeah. So yeah, you're right. Yeah.
Yeah, but that doesn't get away from the fact that the bank's creating it
As a debt as well.
As a debt, yeah.
At interest. So the fairy tale is, this is what I've always believed until recently, that savers put money into a bank and they're like a neutral intermediary, and they then lend that same money to businesses, and that is not the way it happens. What would happen if you made your own money? Any ideas?
You get locked up.
Very good, yeah. get your trousers on, you're nicked. A bit of like, I want to have a picture of Jack Reed in there from the Sweeney, but I couldn't find one. But yeah. Why is that? Why can't we all make our own money?
Because the government has determined that it is the sole arbiter, enabler of that happening, and it licenses banks to do it. So it's part of societal structures, as it were, to restrict the number of people who can produce currency.
Government doesn't like competition, I suppose.
That's true.
Isn't that you technically can create money? You just can't create money the way that, for example, you can't create pounds, but it's not illegal to create your own currency.
That's true, like the Brixton pound.
If you have your own like circle of businesses, people that agree to exchange that currency legally, you could do it. You just can't create pounds.
Casinos create their own form of money as well. That you can only spend in it for that certain business or that certain situation.
Yeah, you could argue no, you can't. I'm going to say Tesco points are in a way, but you can't freely trade them between customers. So.
Yeah. So what does your bank account look like? Does it look like that? There's a safe deposit box with all those notes in? No? Mine doesn't look anything like that. I've never seen that. But I have seen this. Well, it's usually a bit less than that, but there we go. So I have seen that. So my bank account looks more like B. Do you agree with that, yeah?
Yeah.
So, how much of each in the economy? Only 3% of our money supply is notes and coins. A whopping 97% is digital money numbers on banks' computer systems. There's nothing necessarily wrong with that because we live in an age of computers. I don't want to be lugging gold bullion around the place, so there's nothing necessarily wrong with it. But it's not neutral, it's something to do with those money numbers, the origin of those money numbers, how they come to be made. There's something wrong with it. So Positive Money have been through something like more than 500 documents with a fine-tooth comb at the Bank of England. And the Bank of England says that the money-creating sector in the UK consists of banks and building societies. The money-creating sector. Creation as in it wasn't there before, and then it was. And then it suddenly appeared. It's creation ex nihilo, from nothing. Here's another one. By far the largest role in creating broad money, that's digital money, is played by the banking sector. When banks make loans, they create additional deposits for those that have borrowed the money. They create additional deposits. And by deposits we mean the numbers in your bank account, that's what it means. There's Paul Tucker, Bank of England. Banks make loans by simply increasing the borrowing customer's current account. That is, banks make loans by creating money. So it's all there. And this is a more recent one. Where does money come from? In the modern economy, most money takes the form of bank deposits. But how those bank deposits are created is often misunderstood. The principal way in which they are created is through commercial banks making loans. Whenever a bank makes a loan, it creates a deposit in the borrower's bank account, thereby creating new money. This description of how money is created differs from the story found in some economics textbooks. Okay? So nor is the central bank money multiplied up. That's the way it happened decades ago, but that's not the way it happens anymore. And if you're in any further doubt, Martin Wolf, Chief Economics Editor of the Financial Times, has this to say: the essence of the contemporary monetary system is the creation of money out of nothing by private banks, often foolish lending. Also, Lord Adair Turner, the financial crisis occurred because we failed to constrain the private financial system's creation of private credit and money. So, I'm afraid to tell you there is no money in your bank account. Sorry to tell you that. Your account is not a safe deposit box. When you put money into your account, you actually lend it to the bank. So when you see some numbers, positive numbers on your bank accounts, it's basically the bank shows you how much it owes you. It doesn't mean there's any money in there really. This is what Mervyn King had to say, former governor of the Bank of England. Of all the many ways of organising banking, the worst is the one that we have today. That's an extraordinary comment. I think he's an honest guy. Extraordinary comment. So basically our money supply has been privatised. So what it is, these money numbers are created whenever a loan takes place, and we effectively rent the use of our own money. So British pound sterling does not belong to you or me, it belongs to a banking elite, and they rent out those numbers at interest. So we basically have, and I quite like the phrase renter currency. So we have a renter currency, we have to rent the use of these money numbers. And the banks and financial institutions have a monopoly over that one and only means of exchange. You know, what's wrong with my money numbers? You know. So they're basically charging us lots of money in order for us to be able to use their numbers. We have basically what's called a debt money system, where debt and money are birth twins, they're created at the same time. The problem is it's a catch-22. If you want more money, you have to take on board more debt. If you want to reduce your debts, you have to make do with less money. So that's a catch-22 of our current system, which is why it's unstable. How much money have banks created? First of all, who decides who creates it? The incentives for bank staff. Do they lend or do they not lend? If they lend, they get a commission, they get a bonus, they get to keep their job, and they may get promoted. So what's the incentive if they don't lend? Whoops. They get fired, probably, ultimately. Sorry, you haven't made enough money for the bank, so bye-bye. And that's the better of the two.
Sorry, I don't want to interrupt your flow, but I was going to say this earlier. Essentially, behind all this, what the banks are doing is buying your labour. That's what they're buying. They're buying your skills and your time to do something to get recompense that you will then be able to pay them back for the loan. So what is actually at the bottom of this, it's not even assets such as houses, etc. It is the labour and the time of the people who are working. So, you know, that's underneath it all, really. It's what we do with our time. And we get jobs and we go to work and we earn money in order to pay these debts.
Yeah, I think that the profound thought is that all of us in this country are artificially in competition with each other to get out of an unnecessary debt.
Yeah.
That's what it is. That's the game that's being played, and I didn't vote for it. It's nasty. It's it's very inefficient. It's just wrong. So here we have. Look at all this, loads of money. Look at that, eh? We've got 500 billion, a trillion there, 2 trillion. So this is a graph to show the amount of money and debt in the UK economy. So this is 1969. You see this line here, that's the amount of physical cash. There. The next one, the green one, is money created by banks. That's actual money numbers. And then the line above that, the red line, is our total debt to the banks. So the debt is higher than the money supply, which makes no sense to me whatsoever.
Is that normalised for inflation?
No, it's just the amount of money in the economy. If inflation will be the change in the money. But these are actual absolute values calculated by the Bank of England. inflation is is comparing one value to another value a year later, and then you can tell what the RPI or CPI inflation is from one year to the next.
But I'm
Yeah,
just wondering
it's
if
the
that
change.
curve shows
Inflation is the change.
Yeah.
But yeah, it will contribute to inflation, certainly. Yeah.
What's your side?
So let's just see how they go up. So I'm not quite sure why this bumps here. Something to do with computers or something. I'm not quite sure what that is. But
Is it deregulation of the market?
could be the big bang. The big bang was kind of here. It could be that. Yeah, I don't know. There's an interesting little feature. But the point is, you get this massive growth, and it's not even a straight line. It's a hockey stick shape. It's an exponential function. So you get a massive growth in the money supply, and then the debt is growing even faster, and there's always more of it until the financial crash hit 2008. Then what happened was that the money supply flatlined, and the debt's kind of interestingly decoupled a bit, and it's kind of come down a bit. But basically, the whole thing just crashed and just flatlined. I forget, this is back to my argument with the banking apologist. He said it was a money multiplier effect, but it's impossible because the shape of the graph's wrong. It's mathematically wrong, so it's not a money multiplier. So the amount of new money created by commercial banks each year. So in 2007, the amount of money they created would have been enough to pay for all universities, all schools, all the health service, the entire defence budget, and also the police budget. And half of that went on pushing up house prices instead. This is interesting. The 5 years leading up to the crash, so 2004 up to 2008 inclusive, this is how much money they were creating. If you add all those up, it's £860 billion of money that they created, okay, as an interest-bearing debt. Now, something called QE for the People that Jeremy Corbyn did actually support a couple of years ago. He wanted to create 500 billion of debt-free money every year and put it into the infrastructure. People are up in arms saying, oh, it's going to be inflationary. Well, what about this? You know, it's more of it, and it's based on a debt as well. Anyway, so just put that on.
So we're saying that most of the debt is about mortgages. You were saying
About half of it is mortgages, yeah, 51%.
Okay.
It's about assets. It's about pumping money into assets. And the way inflation works is, if you have too much money chasing too few goods and services, you get inflation. That's very well known amongst all economists. So if you pump too much money or create too much money into an asset like houses, but there aren't enough houses, so there's too few houses, you will get an inflation of that asset. That's how it all works. That's why your house prices are far too high. So banks have complete control over the shape of the economy. So banks, loans, goes to the public, and we pay a lot more back because we have to pay back the capital plus the interest. And if banks don't lend, there is no money, or the money will quickly run out as loans are repaid. The money supply will shrink, and that's kind of what happened after the crash. It kind of flatlined. So what percentage of bank lending do you think goes on business? Is it 50%, 22%, 8%, 75%? You call a friend if you like. Any ideas? Who's going to vote for A? Any takers? B? Okay, C? D? Okay, mostly C. C is correct. Only 8% of bank lending goes to viable businesses.
Do you happen to know if that's true in Germany and other European countries?
I don't think it is. That they do have a better system there, where the state does step in, and it's not the same as the UK.
No.
They do have a better monetary system there. Yeah.
We're a particular basket case, aren't we?
I think so. Yeah. It's so the remaining 92% of bank lending, if you like, goes on not doing something useful, but it goes on speculation and property. So that's why house prices are very high. So the other thing is we're actually subsidising the banks. The argument is that, oh yeah, they're paying all this tax. Okay, they're paying all this tax. Yeah, the City of London employs so many people, £18 billion and £8. So this is what the banks are paying into the Treasury every year. For the year that this was taken, this was 2012, I think, this particular graph. However, what you don't see is the red is what they should be paying government, but are not. So we have a taxpayer-funded safety net, and this is what the Bank of England worked out is what it was worth, because we know that figure now because banks were bailed out. So we know what this insurance is now. And there's also extra 30 billion it's worth to them as a license to be able to effectively print money, although print in very commas.
So where did that 100 billion safety net come from?
It's worked out by the Bank of England, based on bailouts that have happened. They said this is what it would be worth.
But where did it? Yeah.
But they're not paying it.
But where did it actually come from? Did the Bank of England just write off certain debts by the banks, or did the Bank of England create more money to pay to the banks?
No, they were bailed out by the state.
Yes. Yeah, by the Bank of England, yeah.
But so all the profits were given to the banks, but all the losses were socialised via austerity.
Right.
Yeah. So that they're not paying this in red. They should be paying this if they're being realistic. But so basically it's a one-way bet, and they always win. And there's evidence there from the Bank of England website. 100 billion is what it's actually worth. That deposit insurance it's called. And without that subsidy, the banks would be unprofitable and would not be able to pay bonuses. And the National Audit Office reckons that about £500 billion was lost from the economy as a result of the financial crisis. And the taxpayer foots the bill. So it's supportive socialism for the banks and harsh capitalism for you and me. It's great, isn't it? I'm going to be critical of Gordon Brown now. I don't mind Gordon Brown. I think he did some good stuff. Like he did help to eliminate third world debt. And he didn't really make a big show about that. So I think he was good for that. But he didn't understand the banking system at all. And this is what he said 2 months before the credit crunch, before the Northern Rock crisis. The financial services sector in Britain and the City of London, at the heart of it, is a great example of a highly skilled, high value-added, talent-driven industry. Britain needs more of the vigour, ingenuity and aspiration that you already demonstrate that is the hallmark of your success. Ouch.
It's not talent-driven, it's just speculation. It's just
Exactly.
guesswork.
So I'm being critical of Gordon Brown. I'll be critical of David Cameron in a minute, just for the...
Well, I may be, this is terribly biased probably.
Yeah.
I always imagine the culture in the City of London is a collision between public school boys and East End Barrow boys coming together to basically rip everybody else off.
There was an element of that, yeah.
Agreed.
So like I said, it's a one-way bet. The banks are free to use, save as money as they see fit, and we have to pick up the tab. So we're privatising the profits and socialising the losses through austerity. That's a picture of a parasite. I don't know why that's there, actually. No, but it's a serious point. A parasite, the definition of a parasite is an entity that lives on a host and it extracts good things from the host and doesn't give anything back. And sometimes it destroys the host if it's particularly nasty. So I think the analogy is fair. I don't need to really labour the point. So what this means for us is a lifetime in debt. We can never ever get out of debt. We are perpetually indebted to the financial sector. Debt is a claim on future human labour, and an unnecessary and excessive and unreasonable claim. Debt is an unreasonable and excessive claim on future human labour all the stress and anxiety that can cause. So that's the game that's being played. So if banks create all the money as a debt, so you've got positives and negatives, the average cash wealth will always be zero, but though it's worse than that, it's actually negative, like I pointed out earlier. So we have a figure here of, in 2008, of 2.6 trillion pounds, that's the debt we owed to the banks. And here the money supply was 2.2 trillion pounds. The difference is 400 billion. So even if, in 2008, we paid off as much of our debts as possible and ended up with no money in the economy, we would still owe the banks 400 billion pounds. So if that doesn't tell you that the system is stupid, then I don't know what does. But it's just absolutely outrageous. Yeah. So this is David Cameron's take on debt and maxing out the nation's credit card. The only way out of a debt crisis is to deal with your debts. That's why households are paying down their credit card and store card bills, not realising that if we pay all of our debts, we have no money. So he was clueless as well. And he resigned, and he lost.
Oh, the best description of Cameron
Got it.
was, have I got news for you? No, it was What the Week. And it was like the bloke who sort of like causes an accident on the motorway, right? So just some hard braking or something. Everybody's this massive pile, and he gets home and sees it on the news. He says, "I was nearly involved in that." And that's basically Cameron and Brexit. You know, it's like he drives off and leaves it.
So we have this elaborate financial system where the money supply is dependent on lending. So there's no stable money supply. I mean, in the Roman Empire, for instance, was built on cheap copper coinage, permanent tokens that circulated around. There's also Abraham Lincoln's greenback currency, is also permanently circulating tokens, free of debt. There's all manner. There's Henry I's tally sticks, strips of wood that circulated in the Middle Ages. But what we have now is different. It's just this weird, funny money system. So there's no stable foundations to it, and so it keeps on collapsing as you lend more, you spend more, borrow more, owe more, repay more. But it reaches a point when you have defaults. You know, people cannot pay their debts because there's more debt than money, so it's kind of guaranteed to happen periodically. Less lending, shrinking money supply, less spending, recession, and you get this ridiculous system of boom bust, boom bust, boom bust. And sometimes there are small ones, sometimes they're very big. This is always quite satisfying watching that, so essentially we have a GOC1 economy. It's all about the confidence. It's a bit like a Ponzi scheme, you know, a pyramid scheme where the whole thing's propped up by new entrants paying into it. There's nothing there really, nothing of value there. It's kind of a bit like that.
How does this relate to getting rid of the gold standard in the 1930s, or was it 40s?
Gold standard.
Yeah.
Ask me at the end.
Okay, yeah.
Okay. It's a good question. Should our money be backed by a precious metal?
Yeah, which
Yeah.
Gordon Brown got rid of. Is that right? Yeah.
Yeah. I personally think there's nothing wrong with a fiat system. Fiat, by the way, means let it be so. So a government says, you know, this money is now legal tender, good for the payment of taxes. You can use it to pay off a debt, or cannot be refused to pay off a debt. There's nothing necessarily wrong with that. I think basing it on a precious metal, I'm not sure. I mean, that has caused problems as well. Julius Caesar introduced the gold standard, and I think that contributed to the economic decline of the Roman Empire, massive inequality. Also, the book, The Wonderful Wizard of Oz, is all to do with the gold standards, the yellow brick road. Dorothy was originally wearing silver slippers, not ruby. So it was to do with silver and metal, and Oz ounces. So that was basically a warning by L. Frank Baum, who wrote the story that became the film, as like a warning, like an economic allegory that we shouldn't really trust the gold standard or the silver. The silver.
Standard.
Yeah.
Yeah, it was about the farmers in the south of America.
Yeah. So yeah, there are problems with basing it on metal. The other thing about because gold, there's a finite resource.
Mhm.
So if you're going to base, you need some flexibility in the money supply. So if you want to increase your money supply, you can't really have it dependent on gold and all the people who hoard the gold. You put more power into the hands of the people who hoard the gold.
Yeah.
It's like the Wicked Witch of the West wanting these silver slippers. You know, it's anyway. Digressing a bit.
Tied into the volume of physical gold was just constraining the ability of people to lend money and to use money. So they came off the gold standard for that reason. But the whole thing's quite irrational anyway, because what are you going to do with gold? It has very little intrinsic value. You can use it to make jewellery and stuff like that, but it was just another form of exchange. The real problem is where the ownership of money creation and the supervision of money supply, where that sits. Is it in public or is it in private hands?
Yeah.
That's the key question.
Yeah.
Well, they used to say for every pound you've got, this was the very naive idea, that for every pound you've got, there's an equal amount of gold to back it up.
Yes.
That's the traditional,
Yes.
50 years old.
Yeah. At one time, you could demand your bit of gold from the Bank of England.
Mhm.
That will have that behind a long time.
So what are the consequences of the current system? It guarantees poverty. Why? Because someone must hold the debt for us to have a money supply. Everything is London-centric because that's where the big financial centres are located. So the net flow of interest goes to London. That's why the prices in London are much higher than Leeds and Edinburgh, which are much higher than elsewhere in the country. It guarantees inflation because we have 8% increase in the money supply per year on average. That doesn't mean 8% inflation, but there's an equation which links money, quantity of money and price level. That's called the Irving-Fisher equation. So it certainly does increase inflation, guarantees a certain amount of inflation. So basically, that's a tax on money itself. The money in your pocket is being devalued with time. It's also unfair because essential things seem to have a higher inflation than non-essential things. So that affects people at the bottom of the ladder more. So the three essential fixes are: make them ask your permission before lending, I suppose. So you could have a similar system to what it is now. Savings account or what we call a current account, and a savings account where you can invest it. At the moment, it's all muddied. There's no clear division, not really. And under a new system, it would be pretty much the same. They might charge a fee for your current account, but £5 a month is nothing compared to what we're paying for all these unnecessary debts. I'll just whiz through this because it's not really. But any investment account, if the bank goes bust, then that is actually your money. Doesn't belong to the bank. But actually make sure that this section was your money. You can move it to another bank by law, so you don't get bank runs. And anything that you've invested get divided up, and the government doesn't bail anybody out. That's the problem with the current system, is the bank bailouts. You can make them tell us how they'll use our money. So if you don't want to invest in cluster bombs, then say no. Whiz through that. and return the licence to create money to democratic power. And that sounds a bit totalitarian communist, but it's not really, because I'll talk about the basic, the summary is that we want newly created money should be spent into the economy by the state, not lent into the economy by private banks. That's a basic summary of what's needed. More debt-free money, less debt-based money. That's what is needed. And it's not a new idea, because this geezer here, Robert Peel, a Conservative Prime Minister, in 1844, he came up with the Banking Charter Act, because at the time the private banks were issuing banknotes or sort of willy-nilly, and it created an asset bubble, it created some economic problems. So Robert Peel said only the Bank of England should create banknotes and bank coins. However, the private banks today have bypassed it, because that Charter Act does not include digital money. So they've managed to bypass it and circumvent it that way, even though it still hasn't been repealed. Robert Peel, repealed. You know.
As you said, banks are licensed by the Bank of England. So it's not that control doesn't exist, it's that control is not very good.
Yeah, it needs a complete change in the remit of the Bank of England, to give them much greater powers and to actually be able to create debt-free money, which they have done with QE, to be honest, this quantitative easing to buy back government bonds. They've done it anyway, but it needs to go into the real economy, because all that's gone is speculation and stuff, and house prices. But so I agree, so it needs a complete change in the remit of the Bank of England and their relationship with government. So it's not illegal to create digital money, that's the problem. Who should decide how much money is created? Should the banks decide? No. Should politicians decide? Ideally not, but we've reached a stage where they probably have to a little bit. Ideally what you want is a division within the Bank of England that has no political influence from government, is accountable to Parliament but not government. Ideally that's what you'd want. It has to be transparent, and control over the money supply would be out in the open. It wouldn't be this nebulous mass of nonsense. Less than 5 minutes left, okay? So I'll hit you with this diagram. This is the current money model. This is our current renter currency. Okay, so here we have the private banks in the middle. They are creating this money, putting it into the real economy and the state. So the medium of exchange originates as interest-bearing commercial loans. And then this money kind of circulates around the real economy. We pay back the principal plus the interest of the banks. And they're at the centre of this web of debt and growing fat on it. The money supply is temporary, because it's all chasing a debt in a given time. It must be constantly replenished with new loans. Well, that's the other point. Yeah, so if you get a loan from a bank and you pay it all off, where do you find the money from for the interest? The theory is that you need bigger loans in the future. That's why you get this hockey stick shape. You need bigger loans in the future to pay for the interest on the original loan. That's how daft it is. So we have so the non-banking sector, that's you and me, perpetually indebted to financial institutions. That's what we have at the moment. The alternative is for the state to create all of the money debt-free, and then the banks just attract the money that's in the system. Okay, and then try and glean a little bit of profit from that. And then you would have debt-free, permanently circulating money, it'd be a permanent money supply, and the taxes could be paid back to the state. But some people argue, oh, that's not flexible enough, you need a bit of flexibility. So this is something the Green Party seemed to support in 2015, where some new money could actually be lent to the banks for on-lending, so that gives a little bit of flexibility in here. Okay? So that's the essential thing. So it's got mostly debt-free, mostly permanently circulating money. But there's a bit of state lending to banks, which is okay, I think. Nothing wrong with that necessarily. And then QE for the people, which is something that Jeremy Corbyn was in support of in 2015, where you have the existing system, so it's still a renter currency, but the state does actually create money debt-free and puts it into the real economy via the infrastructure. So you would get an increasing quantity of debt-free money that way. So that's also, I'm a supporter of this because it's very easy to implement. You just do it. They seem to have changed their minds a little bit though, and taken a backward step, I think. So originally, the Green Party wanted all state-issued, newly created money. The problem with that is it requires some planning. Banks don't require a bailout for that one, and they'd be independent from government. QE for the people, we have some state-issued, newly created money. It requires minimal planning. Banks may still require a bailout though, unfortunately, but probably less risk, and they're not independent from government. But what's happened now, in 2017, is that the Green Party wants to nationalise the banks. So it's not just about the Bank of England and the state, they want to nationalise all the private banks as well. I'm sympathetic to the idea, but I think it kind of misses the point a bit, and there's nothing wrong with commercial banks making commercial decisions, but they shouldn't be allowed to create the money as a debt. And also, I'm a bit annoyed with Jeremy Corbyn because he's backtracked on his QE for the people and seems to kind of like maybe listened too much to John McDonnell and then just ditched it. Oh, that's too weird, can't deal with that. So instead he's going for the fiscal policy, so tax the wealthiest 5%. Well, you can get some way with that, but at the end of the day, it doesn't deal with personal or government debt. You need debt-free money in the system. What about inflation? Well, create money, there's plenty of money, debt-free, and do it as long as inflation is low and stable. And we need to have one measure of inflation, like RPI is an accurate measure. CPI, they need to ditch that because it's always like 1% less, and is used by people like George Osborne for political tricks with pensions and stuff. And you need to stop or slow down the rate of money creation when inflation starts to rise beyond a certain level. So you can directly control the quantity of money and you have much more influence on inflation. And you can also raise interest rates to reduce long-term inflation anyway, to take money out of the economy into savings. That's another way of doing it. And because the interest rates are far too low anyway, they need to be back up to 5% or something realistic.
Can you remember when they were 15?
Yeah.
That was pre-crash.
Yeah.
That was fun.
But a quarter of a percent is ridiculous. It needs to be like 5% or something. So what this could mean for us, what would you do with the money? Well, you could do a variety of things. Spend more on public services, you could cut taxes. So that's what like a more left-wing government would do that. A more right-wing government would cut taxes maybe. You could start to pay down the national debt in a controlled way, or you could just give it directly to people via a citizen's income, which I think is still a Green Party policy. You'd have to fund it this way, I think. And so it's decided by a democratic mandate.
I hope in terms of, in that category of spending on public services, that would include investment in things like, conversion of the economy to a carbon-free structure.
And a democratic mandate, do whatever you want with it,
Those are the things that need to be done, but nobody seems to find the money to do.
Yeah, I agree. So the result is you'd have falling debt and poverty. So the new debt-free money would stimulate the economy whilst reducing the overall debt burden. So the money supply would do that, and the debt would come down with time. Be less power for the banks. These are the pitfalls of the current system, which we talked about. the new system, banks would live and die by the sword, no bailouts, or less chance of bailouts, no subsidies, less demand for loans because people wouldn't need to borrow as much, falling debts, and much more economic stability. So third world debt could be reduced further. That amount of money there was enough to offer debt cancellation for the poorest 50 countries in the world. Funding for the environmental crisis. This amount of money there in 2006 would have been enough probably for the complete transition to clean renewable energy. So the money supply would be nationalised, banks would remain private and would be account holders in the nation's money supply, wouldn't be allowed to go into the red, and they would not be allowed to lend money they don't have at interest. So in law, well, Positive Money had drawn up a bill which could actually be passed through Parliament. You could join Positive Money, they've got loads of stuff on the internet, you can tell your friends, educate your MP.
Impossible.
I put that in as a joke. In fact, I wrote to Alex Shelbrooke about this, and his reply, he did reply eventually, his reply demonstrated he didn't even understand the question.
Yeah.
He said, oh yeah, we're regulating the banks much better now. Well, you missed the point, you doofus. Anyway, educate your MP. So what do we really want in this country? An economy based on debt and contrived scarcity, or one based on prosperity and abundance? And anyone who thinks they can solve a debt problem with debt-based money is either an idiot or an economist, and somebody famous said that. So there we go. Thank you very much for your time.